Discover how inflation stealthily erodes your savings and investments and the strategic moves to safeguard your financial future. Hello everyone, and welcome back to No Money. Today, we're diving deep into a topic that affects each and every one of us, whether we realize it or not: the impact of inflation on your savings and investments. You've probably heard experts talk about inflation, but do you truly understand how it can shape your financial future? Stick around, because we're going to break it all down for you. Let's begin. Understanding inflation. All right, let's start with the basics. What exactly is inflation? Well, in simple terms, inflation occurs when the prices of goods and services steadily increase over time. It's like that silent thief that steals the purchasing power of your money. Picture this. You want to buy a bicycle today for $100, but with a 6% inflation rate, that same bike will cost you $106 next year. So, what cost you $100 now will cost you more in the future. In the 1960s, a single dollar could get you a lot more than it can today. Back then, the median house price in the U.S. was just $20,200. And a year of college tuition at the University of Pennsylvania was a mere $1,570. But over the years, wages and prices have gone up, making the value of that single dollar decrease. That, my friends, is the essence of inflation. Now you might be wondering, how does inflation affect you personally? Well, the Bureau of Labor Statistics reported a 6.4% inflation rate from January 2022 to January 2023. But remember, this rate can fluctuate based on the state of the economy. The impact on your savings. All right, let's dive into the nitty-gritty of how inflation affects your hard-earned savings. It's crucial to understand this because your savings are the cornerstone of your financial security. So how exactly does inflation chip away at your savings over time? Well, picture this scenario. You've stashed away $10,000 in a safe place, perhaps under your mattress. Now, as time goes by and prices steadily rise due to inflation, that $10,000 doesn't pack the same punch it once did. You're not technically losing money, but the value of your savings is diminishing in real terms as inflation eats into your purchasing power. Now you might be thinking, I'm smarter than that. I keep my money in the bank so I'm protected from inflation, right? Well, not so fast. Banks do provide you with some interest on your savings, which can help counteract the effects of inflation. This is especially true when inflation rates are high because banks typically offer higher interest rates in response. However, here's the kicker. In many cases, the interest earned might not grow fast enough to fully offset the loss in purchasing power caused by inflation. In essence, while your money in the bank is growing, it may not be growing at a pace that keeps pace with the rising cost of living. So the real value of your savings is still gradually declining. This is precisely why many financially savvy individuals choose not to keep all their money in low-interest savings accounts. Instead, they diversify their financial holdings. The impact on investments. Moving on to the exciting part, how does inflation affect your investments? Well, it depends on the type of investment you have. Let's break it down. First up, we've got investments with fixed returns, such as regular bonds or bank certificates of deposit. These investments can feel the pinch of inflation because the interest you earn each year remains stagnant. Imagine you're earning $100 annually, but as inflation creeps in, that fixed amount becomes worth less and less over time, chipping away at your purchasing power. But what about stocks? The stock market, a dynamic arena where inflation can have a mixed impact. Typically, inflation tends to rear its head when the economy is in full swing. This often translates to boosted company profits and higher stock prices. However, it's a double-edged sword. Companies also face increased expenses, such as rising wages and material costs, which can put a dent in their overall value. So whether inflation benefits or harms a particular stock largely depends on the performance of the company behind it. Now, let's turn our attention to commodities, such as oil, agricultural goods, and precious metals. These commodities have a historical track record of performing well when inflation is on the rise. Why? Because they often serve as a hedge against inflation. As the value of the dollar declines, it takes more dollars to purchase the same amount of these commodities, effectively preserving your purchasing power. Lastly, there are investments designed specifically to address the challenge of inflation risk. These investments have the unique ability to earn more when inflation is on the upswing and less when it's in decline. This feature ensures a more stable overall return. Some bonds and annuities offer this capability, though it typically comes with an added cost. Planning for inflation. Now that we've uncovered the impact of inflation on your savings and investments, let's explore the crucial aspect of planning for inflation. After all, being proactive is the key to staying ahead in the financial game. First and foremost, it's important to realize that inflation is a force that you can't entirely avoid. It's like a natural element in the financial ecosystem. However, by planning for it and adopting a sound investment strategy, you can significantly mitigate its impact on your financial well-being. One of the first steps in preparing for inflation is to diversify your investments. As we discussed earlier, relying solely on low-interest savings accounts may not be your best bet. Instead, consider spreading your money across various types of investments. Some of your funds can be allocated to potentially higher growth options like stocks or mutual funds. These investments tend to outperform the inflation rate over the long term, although they do come with a certain level of risk. But don't stop there. When deciding on your asset allocation, take inflation risk into account. Fixed investments like bonds or fixed annuities can be particularly susceptible to the erosive effects of inflation. To counterbalance this risk, some investors opt to include assets like gold or Treasury inflation-protected securities, TIPS, in their portfolios. These investments are designed to provide returns that adjust for changes in inflation, helping you maintain your purchasing power. It's crucial to remember, though, that diversification and asset allocation strategies, while effective, can't guarantee a profit or protect you against losses in a declining market. The world of investments carries inherent uncertainties, but with the right strategy, you can minimize the impact of inflation. Lastly, stay informed and keep an eye on the financial landscape. Monitoring economic trends and staying up to date with market news will empower you to make informed decisions regarding your investments and financial planning. Inflation is a market force you can't entirely avoid. However, by planning ahead and implementing a robust investment strategy, you can minimize its impact on your savings and long-term financial goals. Remember, knowledge is your greatest ally in the world of finance. Stay informed, make informed decisions, and keep growing your financial literacy. If you found this information valuable, please give us a thumbs up and consider subscribing to No Money for more in-depth financial insights. And as always, if you have any questions or want us to cover specific topics in the future, don't hesitate to leave a comment below. Thanks for watching, and until next time, stay financially savvy.